understanding all the options available in the CARES Act and making sense of the best choices for you can be a huge headache. For one thing, you have to spend countless hours reading through articles and searching for explanations, or nag your colleagues and hope they got the right answers. You also have to calculate the break-even on employee layoffs compared to SBA loan forgiveness compared with long-term economic stability for your practice. Plus, there's the challenge of guessing at whether the interpretations of these new laws might change in a week and completely derail your strategy. As a result, managing your financial well-being and the cash flow in your practice during this uncertain period is a more time-consuming and all-encompassing hassle than you ever bargained for. Fortunately, there's a better way. Introducing Moss, Luse & Womble, a one-stop financial planning and accounting firm that specializes in the unique needs of dental professionals, so you can relax, knowing you've left the complexity of analyzing all your options to the experts. With Moss, Luse & Womble, we allocate appropriate resources to provide accurate and vetted information to all our clients and their colleagues that can be trusted. Then, we speak with our clients to help them understand their individual situations and customize a plan. And when these more immediate concerns wane, we'll spend a full day learning about you and your goals. In addition to being the foundation of your step-by-step financial plan, this in-depth consultation will also serve as an integral part of the process every year going forward. And of course, you can also trust in our commitment to personalized service, like speaking directly with a member of our team via email or phone whenever you have questions or need advice. One of the smartest ways to ensure the health of your practice is to put sensible routines into place. Our accounting, tax, and payroll services are designed to help you keep your finances in the best shape for the long term. But perhaps the best thing of all is that our services are designed with efficiency in mind. We integrate those tax and accounting compliance services with our tailored personal and business financial planning advice. This often saves you time and money. To learn how MLW can provide vital solutions and expertise you need to achieve a sense of balance, direction, and peace of mind during these turbulent times, review our website at mlwfinancial.com or call our office to schedule an introductory meeting at 972-674-2584.
Good evening, everyone. My name is Jeff Moss, and I'd like to welcome you to the next installment in our MLW webinar series regarding the impact of COVID-19 on your practices. Now, phase one of the PPP loan process has come to an end, as the $349 billion approved by Congress for these loans has been exhausted. But what does that mean for you and your practice? Some of you received your approval and already have funds sitting in your bank account. Others were not so fortunate, or perhaps just chose to wait. This evening, we want to address the concerns that exist on both sides. We want to answer the question that many of you have, regardless of PPP funding: what next? For those on the outside looking in, we have good news about potential additional funding as well as alternatives that can still provide you benefit during this crisis. And for those with PPP funds, we're going to discuss how to optimize the benefit from that program. Now, our goal, as always, is to provide you with well-vetted and thorough information to help you make an informed decision. Our panelists this evening are going to be just myself and my partner, Jason Luse, as we take a tag team approach to providing you with up-to-date information and answering your questions live. Speaking of which, if you do have questions for us, please use that Q&A feature located in the application. We will answer the most commonly asked questions live, and we also have a separate off-air panel that will be responding to some of your questions via that Q&A function. So, and as a reminder, we won't be using the chat feature. So we're going to get our webinar started by first addressing those of you still without any PPP funding. So we'll get those slides brought up. All right, so let's start with basically looking at what happened. So, you know, if you basically delayed applying to try and maximize forgiveness, then it kind of boils down to, you know, you just bet wrong. You know, when we looked at this webinar, or we looked at this information from a prior webinar, we looked at a couple of options. We said, you know, you potentially may want to apply now, or you may want to delay and wait. And, you know, there were goals with potential up and downsides to each. So if you chose to wait, your goal was to look at maximizing forgiveness. And of course, the downside from that was that the program might run out of money before you have the opportunity to apply and get in line. Now, we do know that many of the banks, as well as some of the other contacts, were debating on whether or not the money would last for 1 week, 1 day, 1 month, etc. More of them were thinking it would go quickly. So in most cases, when we looked at this review, we said, look, if you don't know how to go either way, yeah, then play it safe. Go conservative, apply now. Some of you didn't need that money up front, and you potentially wanted to kind of, you know, roll the dice a little bit and wait to see if that money would last and you can maximize your forgiveness by delaying taking any of that money to further into the time frame. And unfortunately, the money just run out. Now, that's not everybody. Some of you didn't choose to wait. Some of you did go immediately forward and begin applying. And in those cases, it might have been some other issues that came, you know, into play here. So if you did apply early, then your bank likely was just not prepared to handle the amount of applications that were received. We're going to roll to that next slide here. So what does that really mean? Well, it means that these banks were basically overrun with hundreds of thousands of applications for PPP money. And unfortunately, those banks and their processes were just not ever designed to imagine doing that kind of work. And speaking with one banker, we heard that they're doing more work within a 3-week time frame, more loans that they would typically do in a 9-month time frame. So they're just not set up to be able to do that as efficiently as they would obviously like. Now, you might have also heard that smaller banks with fewer customers were more likely to get their applications through the process faster. And to some extent, that was true. You could say that there's less red tape that was involved. Based on our experience, it looks like that some of the larger banks took a little bit more of a risk-averse approach. They were a little bit concerned about the SBA and the way that their guidance would be coming down, and if that would change whether or not, you know, these certain loans would get approved or not. And they were concerned that they might have issues if they just put through some of those loans. It seems that some of the smaller banks were able to work with those customers a little faster and were able to take on a little bit more risk and willing to put those through. I'll also mention that some of the larger banks, while maybe not getting as many loans through, or certainly as a ratio, not as many through, it does appear that they potentially did, those larger banks did, you know, larger average loans. So whereas the typical small bank might have been something like $80,000 to $150,000 loan size, some of these larger banks were averaging more like $600,000 to $800,000 per loan. So it lends itself to think possibly that some of the larger banks were focused more on the bigger loans and some of those larger companies to be able to help. And that might not have played out as well for the small business dental owners that we have. So that's one thing to consider. Now, I will mention that a lot of our clients have been pretty irate with their banks in going through this process, and that they're not being able to get through it. And it makes sense that your frustrations are there, especially if you took that information that we put out on day one, went through with the bank and the application process and did everything the way that you thought you were supposed to do it. But, you know, I wanted to paint a picture before you necessarily, you know, go off the deep end on your banker. And I'm going to credit one of our planners, Miles Kellum, with this. He told a great story, or a great analogy that kind of explained what was going on. And he, you know, he kind of helped out, you know, an overall understanding of how to maybe treat this. And he's been using this with some of his clients, so we wanted to share it. So this is the way the story goes. You know, imagine if the pharma industry discovered a vaccine for coronavirus that had to be administered through a 1-hour oral procedure that could only be applied by a dentist. Okay, so your dental offices are now becoming COVID-19, you know, fixed places. And to encourage acceptance for people to go do it, the government announced that they're going to give a $2,500 rebate check to the first 50 million Americans who had the procedure done. So suddenly, you had all 3,000 of your active patients banging on your door to get the treatment immediately, right? Except that you didn't have the treatment supplies yet. You also were waiting on the CE that was necessary for you to learn how to do the procedure, okay? Now, the reason why you're waiting is because the government said that you would potentially be held liable if you administered it incorrectly. So how would you determine which of your patients you'd fit in to your 5 operatories on that first day? What would you say to a patient who told you they'd be switching dentists after the crisis because you would cost them $2,500 by not getting them in for their procedure? And what if they said, that they would be switching to the startup dentist down the street who'd been able to see all of his patients because he only had 150 active patients at the time. Would that make him a better dentist than you post-crisis? And, you know, just kind of giving you a little bit of a story there to kind of understand what I feel like the banks were actually going through during this time. So I'm not saying that that is, you know, any more fair to you, but I think that they are struggling a lot in trying to do what's right by their customers. So everybody's trying to fix all of this in a very weird situation. So just kind of something to think about in the back of your mind as you're thinking through how you might have handled something, you know, along those lines. So bigger question is, what happens now? What happens to my application that's in the queue? I did apply, but I didn't get, you know, accepted. So some banks have reported that, you know, their plan is to keep moving forward with underwriting and their own approval process. So in other words, those applications are still being moved through the system, even though the funds are currently exhausted. Now, some other banks have basically said they are on pause until they find out if a second round of funding is to begin. I guess the theory there is they don't necessarily want to commit the amazing amount of man hours that are going to be required to work through that application process if it's not for any purpose. So it kind of just depends on which bank you're with. But overall, what we do believe is that your quote unquote place in line with your bank should remain. Now, that does not mean a place with the SBA per se. So I want to kind of give you an example to think through. If you went through one of the larger banks especially, you applied with all of your information and there may have been some back and forth on gathering supporting documents. And eventually they had everything they needed and they put that into review. And in some cases, maybe even more than one level of review. Some of them called it payroll review, some of it called total loan review. And within their own bank, they had their own banking staff reviewing to make sure they had everything that was needed and that all the I's were dotted, T's were crossed, and there was nothing that would potentially get that kicked out or run afoul of the SBA guidance and rules. Once it got through that level, then it was sent through the SBA, that has to be done by the banks, sent through to the SBA to get that approval. Now, once that approval was made, then you would get what's called an E-Tran number that basically said you are now tracked and money has been allocated for this loan in the big pot of money, okay? So in some cases, some of you actually got to the SBA, but did not get the approval in time before the money ran out. Some of you are still at the bank level before it got sent in. So when we think about this as a line, it's not exactly one big line. You're basically in, you know, a line within your bank, and the faster you get through that, then you go into the line with the SBA. So we do believe that your place in line is being held. We just can't exactly tell you where. So think about it this way. Just because you're not with the SBA and that you are in line with your bank doesn't necessarily mean you're in front of somebody else at another bank, or maybe even somebody else that hasn't applied yet. Because if you're at a bank that, say, has 100,000 applications, a larger bank, that are waiting to go through, someone may be at a different bank that gets through faster, sort of jumps in front of you when it goes to the SBA, or at least that's our basic understanding of how that would work. So that's just kind of what's happening with where you're at in the queue. Now, understanding that, it makes sense that people will ask, so should I change banks then? Well, ask the banks, and they say if you do that, it could move you out of line. So if you're number 712 at that bank or whatever, and you say, you know, cancel that out, I'm going to a different bank, then you're basically at the back of the line, wherever that is. How do you measure how long the lines are at each bank? There's not really a way to do that. Now, we are continuing to seek answers from the banks that struggled with this the first go round. You know, Bank of America, Chase, some of the larger banks, and even mid-level banks that struggled to get through that process. We've been reaching out to them to ask, you know, what do we do if we're in line? What type of communication should we be expecting? And to be honest, we haven't gotten a ton of answers from the really big banks. They're pretty underwater. Now, we are getting some information that continues to trickle in via client emails. So clients are still getting approved. In fact, as late as today, we're getting you know, clients emailing us saying that they got an approval from Bank of America. So they are still working through that process. So it's tough to know where you're at unless your bank is literally communicating with you how far behind you are. I know Chase is one of the banks that has been sending out phases to show you where you're at. And they're being honest and saying you may be, you know, 100,000 people in front of you. So you may want to consider other options. So that kind of lends us toward that next step, which is what are the other options if you want to look at changing banks. For our MLW clients, we sent out a mass email yesterday that kind of walked through this. But basically, does it make sense for you to consider a secondary lender option? Now, first thing I want to say is we don't think it probably makes sense to cancel your existing application. If you are further along the line than you think, then you don't necessarily want to hop out of line. So looking into a secondary lender, in other words, just applying at a secondary bank, may be something you want to look at. And I'll go into that in just a little bit more in a moment. But I do want to caveat all this immediately by saying that you're not permitted to apply through these banks to the SBA with more than one. So you can actually make your application. That's fine. When you get yourself into trouble is if you actually get through to that SBA application and they try to approve you in two different banks, okay? So ultimately, they're trying to prevent fraud. Now, none of the people listening to this are trying to commit fraud, or at least I'd hope so, or hope not. But if you are somebody out there saying, look, if I pretend to try to go after this loan at 8 different banks, and before they catch it, I got 3 of them and I'm off to Canada or something, then that's fraud. They want to avoid that. So what we're concerned about is the potential, not that you're committing fraud, but that you might be applying in more than one bank, and then accidentally both of those go through. We don't really think you're going to get handcuffed. What we worry about is that the system might potentially kick out that application. And if it was to do that, potentially by the time you get that figured out and the confusion dies down of what happened and the errors are fixed, the second round of funding, if there is a second round of funding, might have been exhausted as well. So we want to make sure that if you go this path and look at applying at a secondary lending option, that you make sure and inform those lenders, 1, 2, 3, whatever you're doing, to alert you before they actually send it through to the SBA. So that way you can say, once that first one goes through, you'll have the opportunity to cancel the other ones. So just kind of some food for thought. We can't give you the answer as to whether or not you should try to apply at another option. But if you do, to try to improve your odds of getting any funding in this second round that might be coming, that you just want to make sure that you are in charge of crossing those T's so that you don't possibly get that kicked out. Now, as far as the secondary options to consider, one of the things we're looking at as a potential option are the financial technology companies. In that email, we discussed why those might make more sense. They tend to be a little bit more agile. They're a little bit more technology forward. And so far, what we've seen is that their applications are pretty streamlined and they can move through the process quickly. Now, these are not actual banks and lenders, but these are companies that have been given SBA approval to distribute funds through the program. The 2 that we've specifically looked at so far were PayPal and Intuit QuickBooks Capital. So if you were interested in one of those as a faster option, that might be something to consider since they're not, brought down or bogged down by the same processes that most of the banks are. Now, that takes us kind of to the next idea of this, this likelihood of additional funding. So it's being referred to right now as the interim spending package. Now, does that take the form of another bill or some sort of addendum to the original bill? That's still kind of up in the air, but it's being called the interim spending package. So as of, a few hours ago, Congress is supposedly getting close to a deal. Now, what does that mean? They're currently working within the Senate to try to put together a package that's going to provide additional funding. Now, there is the potential for procedural opposition in the House. So what does that mean? It means that as opposed to a voice vote where everybody agrees, if one person says, I don't agree, or I want a roll call vote, then they're going to have to bring back the majority of the House to pass it in person, live in Washington. So that could delay things. Not to mention that the Senate did not get through an approval today, which in theory would allow that to go faster to the House, as some were expecting. So it's potential that we could be as early as this week with a past congressional proceedings, as well as even funding as early as Thursday. We have a U.S. congressman that we've been in contact with that potentially thinks that they could come up with this bill and funding as early as the end of this week. So far, nothing's pointed to that today, but it does appear that they're getting bipartisan support and that they are going to all, for the most part, play along to get this done. So, gun to my head, I would probably say that we should expect some additional funding. When? That's another question. Now, how much is going to be made available? We've seen numbers thrown around as low as $250 billion, as high as $310 billion that would potentially be available for the Payroll Protection Program, with an additional $50 to $60 billion for the EIDL, the Economic Injury Disaster Loan, that would help out with that. So, more of what I've seen recently is on the 250 range. And so we're going to look at a calculation in a moment that assumes that $250 billion number. You should also note that there might potentially be some new requirements with this interim spending package that are different from the first go-round. Now, whether or not this makes it into the final congressional action depends on, I guess, who's got the loudest voice in Congress. But right now, there is some proposed new language that would require the applicant to, quote, show a substantial reduction in revenue due to the coronavirus. That is not language that, or not a stipulation that was required the first go-round. So you might have an extra hurdle to prove, which might require some additional documentation if, in fact, that language makes it into this, this secondary round. Now, the reason for that is, as you may have read, some of these larger companies that might not have as much of an economic downturn as others were potentially taking advantage of the program, completely within the law, but some of the people feel that some of that money is being wasted in Congress. And so they may add some additional language like this to try to avoid that in any second round of funding. So the big question, is it worth delaying on this application? Because we've mentioned to somebody that said, well, I messed up, so to speak, on this first one. I guess I should have applied earlier, but I was trying to maximize forgiveness. But now that this big second round of funding is coming, I feel like I should really probably wait until I've got a good sense of when I'm going to be reopening so that I can try to get the best case for making 100% forgiveness on that money. So we wanted to walk you through some of these numbers so that you could think about this a little bit more. So here are the numbers. In the first round of funding, per the SBA, $342 billion as of April 16th was allocated to be loaned out. That's to approximately 1.66 million businesses at an average loan of around $206,000. Now, you may say, where's the rest of the money? Got to remember that some of that money went to the fees that were that are going to the banks to be able to write these loans themselves, those origination fees. So that's roughly the amount that was loaned out. Now, as of that same day, Senator Rubio, who's the chairman of the Small Business Committee, had mentioned that there were still over 800,000 applications in queue. And keep in mind, that was 4 days ago, and some banks are still accepting new applications into their queue. So that number may have grown since then. So if you assume that same loan average of $206,000, that's already going to take up about $165 billion of this second round of funding, just from the applications already in queue from the first go round, right? So if 250 billion gets approved, which again, that's the number, if I had to guess, that it may land on, it could wind up being as high as 310, as I mentioned. They're still negotiating. That's only going to leave around 400,000 new applications to get approved from anyone who hasn't applied as of that April 16th date. And again, that number may be declining since 4 days ago. That's assuming the same average $206,000 loan. Now, most of you that applied are saying, I didn't get anywhere near $206,000 because, again, you're not the only small business around. There's a lot of businesses of varying sizes. But if that was the same average, we're talking about 400,000 or less new potential applications to get approved if they're not already through today. And to put it, if you think about it, that's only about 25%, actually less than 25% of the number of loans that were approved in the first round. And let's think about how fast that went in the first round. So if the thought process might be now is a really good time to try this delay strategy that a lot of dental forums and different firms are talking about, I think you may want to rethink that strategy just a little bit because there's the potential for this money to run out just as quickly. So if you're thinking about doing it, we absolutely advise that you get on this and get on this in a hurry. Now, if you're in queue, then you got to go back through that thinking of whether or not you want to consider a secondary lending option, assuming that you're going to put those safeguards in place to avoid having 2 loan applications go through to the SBA. So if I didn't get PPP funding and I don't think I'm going to get it, or I think the money's going to run out, or it does, what else can I do? So we kind of broke this into those of you that are concerned about cash flow and those of you that are really just interested in trying to get access to the available funds, meaning I've got my emergency funds. I ideally don't want to blow through all of them, but I can make it last for a little while. For those of you that aren't in that situation, you might be a more of a struggling practice or early in a startup. You don't have that kind of money available. What should you be doing? Well, initially, we mentioned the economic injury disaster loan as an option. Now, that's not currently an option if you haven't already applied. Unfortunately, if you pull their website, this is the, got it here on our screen, there's a lapse in appropriations. That money ran out just like the PPP money. And so it's not currently an option to apply for that. However, if you did apply and you just haven't heard back, even though they're no longer accepting applications, Per the SBA on April 16th, they referenced on their site that within the next 3 weeks, the applications already submitted are going to be processed on a first come, first served basis. So to the extent that even though they stopped accepting applications and the money has, quote, run out, they haven't exactly said the money's been given out. They've just stopped accepting applications to work through them. So yes, it is absolutely going to run out, and there's no guarantee by any means that all the applications that have been submitted are going to be received. It will be first come, first serve, but some of you may still get acceptance on those. Now, in theory, there's another $50 to $60 billion that may get approved as early as this week. When that happens, we just don't know yet if that means they're going to start accepting applications again because there'll be more money, or if that's just the needed amount of money to cover the applications that are already in. That has not been published yet by the SBA that we've seen. So we're going to need to stay on top of that and pay attention to whether or not those applications open up for those of you interested in going that route to try to get some of that money. And just as a reminder, this is the loan that's directly through the SBA, not through the banks. You apply directly through them, and at least with their first funding, you were able to request an advance of up to $10,000 or $1,000 per employee, whichever is less, to try to take that money early, and it basically stays as a grant. That's that loan that we're talking about with the EIDL. Now, outside of that, you still have your current business lender or the bank where you have a business banking relationship that you could still go back and ask for the more traditional line of credit. Again, this is for the clients that are not interested in free money. They're interested in just keeping things afloat. I need cash flow to make ends meet until that we are back up and running after the crisis has ended. Now, some of the banks are not currently, unfortunately, accepting applications for these lines of credit because frankly, they're just underwater trying to get through the PPP loans right now. But once that subsides, they'll start lending that money again. Each bank's going to depend on their own lending parameters as far as your financials, your need, et cetera. But that would be another item to consider. And then I also wanted to mention the original cash flow crisis tiers that we published early on in the crisis. And I'm going to show you those again, just as a reminder. So as you're looking at the different tiers, you're working from left to right, tier 1 to tier 3, on levels of need or levels of desperation is another way to look at it. Most of you are probably already through that first tier. You're going to discuss any lending options with your current bank, like lines of credit. You're going to potentially skip payroll for you and a spouse if your spouse is on payroll. You're going to not make any extra debt payments, and we're going to reduce discretionary spending both at home and in the practice. From there, we move on to the second tier. This is where we've got clients that we're recommending potentially to reduce all employer contributions to retirement accounts. Don't do any extra investing right now if you're concerned about cash flow. I get that the markets are at a better buying opportunity now potentially than they were before this all started. But using that money to get in just to invest and try to take advantage of that, in our opinion, doesn't outweigh the cash flow need if you truly are at a tier 2 crisis level here. Not to mention that there's no guarantee that the market's going to immediately go up versus go down. So think about your cash flow needs first there. You want to reduce credit card payments down to your minimums and potentially seek waivers of interest on those credit cards during that time. And then, of course, you've probably already sought rent deferment with your landlord if that was a potential option. Consider also tier 3. We're now looking at withdrawing money or borrowing from your 401k plan or other qualified plans that you potentially would pay back in the future, or just take as a penalty-free distribution, which is an option right now. You may need to tap available equity in your home, in your practice, or if you own the building that you practice in, just as a way to borrow additional money so that you can make ends meet. And then finally, utilizing full time frames allowed to quote unquote slow pay non-essential vendors. So if you've got a lab or supplier that you typically pay as soon as you get that invoice, but yet they're net 30 and you've got some time, hold on to cash flow as long as possible. Tier 3 is all about making it work until you can get back open. So, there's really nothing quite too desperate here to try to get you through. So beyond that, let's talk about some actual ways that you can take advantage of some of the additional programs that are available. And we touched on these briefly in a prior webinar, but I wanted to just walk through them a little bit more for those of you especially that aren't going to be getting that PPP loan. The first and the least impressive of the two we're going to discuss tonight is the deferment of the employer portion of Social Security payroll taxes. Now, to be clear, when you have taxes that are due each time you run payroll that you pay in through the payroll system, you are paying in Social Security, and Medicare taxes that are withheld from your employees, as well as any income tax, federal or state, that you're asking them to withhold. And then in addition to that, you are matching the Social Security and Medicare that goes in. That's the employer portion. In this particular case, we are only talking about the Social Security part and only the employer part. So basically 6.2% of what those wages come out to be. Now, it's going to apply to any deposits. Looks like my light just turned off in here. I'm not moving enough, apparently. There we go. It's going to apply to deposits that would otherwise be required from March 27th to December 31st of this year. Okay, so we're already in that period, and it's going to last the remainder of the year. The quarterly reporting that all shows up on is that Form 941 that gets filed every quarter. And on the second quarter one, so after the end of the second quarter, June 30th, that form is going to be updated to allow to show the potential for this deferment. So it'll be calculated and submitted that way. 50% of any of the amount that you deferred from March 27th to December 31st, that can be deferred all the way to the end of next year, December 31st, 2021. And then the remaining 50% the year after that, okay? So it's not free money. It's taxes that you are eventually going to owe. It just buys you time. And in some cases, 2 years, basically, or not quite 2 years, the remainder of this year plus another year, and then actually the year after that. So more than 2 years, sorry. 1.5 to 2.5 years. And so it buys you time on that. Now, the reason I said it's not as impressive is in a typical dental practice, that's not necessarily that much money, okay? Now, I did want to point out before I show you an example that it does not apply to employers who receive a PPP loan after you get a decision that the loan is going to be forgiven. So let me explain that a little further. If you applied for a PPP loan, you are still eligible to use that for that deferment. If you get a PPP loan and it's funded, you are still eligible for that deferment. Once you eventually apply for your forgiveness after your 8-week period, and you get a statement that says your forgiveness has been accepted, approved, at that point, you can no longer defer any additional taxes. Now, taxes up to that point that you deferred, let's put a date on it. Let's say it's August 15th. Any taxes that you would have paid up to that you've deferred, you get to continue to defer to those 2 dates in 2021 and 2022. You just can't continue to defer new wage taxes off of new wages from that point until the end of this year. So you basically still have the option to do it. But if you are not going to be getting a PPP loan, then you absolutely could use that math to get you all the way through to the end of this year. So something else to consider is that self-employed individuals are also eligible for this deferment. So if you're an independent contractor and you didn't get a PPP loan, that means that you also have till the end of this year to potentially defer 50% of the Social Security tax on the net earnings from your self-employment income. And honestly, it's a little bit difficult to work this through with the payroll systems right now because they haven't updated their systems to basically say, I don't want to pay it in. So they're still going to basically say that you owe that money and that your payment needs to be made. And then once the end of the quarter comes, assuming that those 941 forms are updated as they say will be, then in theory, you'd be owed that money back that you in theory deferred. So you would still get it back and then eventually pay it when it's due down the road. With self-employed individuals, it's much easier. You just reduce the amount of quarterly estimated tax payments you're making to accommodate that. Now, I do want to make just a quick side note for our MLW clients running payroll. I know a lot of you did not run a payroll on 4/17 because you're potentially using an unemployment strategy during that time. You do still need to log in and check to see if you have current taxes due. Remember that some of those taxes are due on wages that were paid early in the first quarter, or in some cases from that last payroll that you ran. So just because you're not currently using or running payroll doesn't necessarily mean that taxes aren't due. I randomly chose 3 clients today and 2 of them showed that taxes were due. So make sure that you log in right after we're done with our webinar, double check to see if any taxes are currently due and get those taken care of. I would not necessarily recommend just not paying those taxes, assuming that you can make them up later, because again, only some of those taxes you can delay paying. Now, there may be some remedy for penalty for folks that are confused or make some mistakes and that sort of thing, but no reason to purposefully make a mistake there if you can avoid it. Let's take a look at a quick example here. So assume a typical general practice with 1 doctor and 8 employees, and let's assume that we're going to reopen on June 1st. So in a real life scenario that I pulled, we had employee wages of about just a little under 28,000 and doctor wages of a little less than 24,000
on a typical month, okay? Now, the doctor's wages aren't going to apply much because at this point in the year, most of that Social Security cap has been met. So really, we're just mostly looking at the employee wages unless you happen to have a salary set for yourself that's pretty low, okay? Now, employee wages in that particular month, that typical month we looked at, would generate approximately $1,730. Remember, it's about 6.2% of those wages. So if we look at the remainder of the payroll tax deferral period, again, let's assume we're going through the end of the year because we didn't get that PPP loan, that's about 7 months or about $12,000 in change that we'll be able to defer. So half of that, a little over $6,000, we get to defer to the end of 2021 and the other half to the end of 2022. So is it life-changing? No. Is it free $12,000? No. But it does keep that $12,000 in your bank account to use as needed for a bit longer to help you with your other expenses during the crisis. So not the best strategy, but it is something to take advantage of, especially if you're not going to have your PPP loan available. Now, the more exciting of these two options would be the use of the employee retention credit, okay? So if you're not utilizing that PPP loan, then you are eligible to get this credit. And it's a credit on 50% of the employee wages that you pay. Now, there's some stipulations here that we need to walk through. First of all, it only applies to qualified wages. Qualified wages mean they were paid from March 12th through the end of this year and only up to $10,000 per employee. So your maximum credit to get is going to be $5,000 per employee because only up to $10,000 per employee will count. Now, what does qualified mean other than the fact that it needs to fall within that period for it to count? Well, it has to be paid during a closure, meaning operations were suspended, or during a period of, quote, decline in gross receipts, okay? So first, that closure. Even if you've got a partial closure, it's our opinion that you are going to qualify there. So if you're only meeting for, you can only go in to solve emergencies with your patients because the government has basically shut you down, then we believe that that is going to qualify during that time. But you're also talking about this decline in gross receipts as an option. So what does that mean? Well, technically speaking, begins with the quarter where there's a drop of at least 50% in revenue, and it's going to end after the quarter where that revenue is up to about 80% compared. But I want to show you in an example to make it a little easier than just trying to read that and make it make sense. Visual learning is usually better. I also wanted to mention that in addition to the actual wage expense, you can include any employer-paid health insurance premiums as part of that number. So if you're struggling to get up to that $10,000, that employer-paid health insurance premium might benefit you, might help as well. So on that next slide, we're going to show you sort of a visualization here of what this might look like. So consider that we're looking at the year 2020 in front of us. There's all 4 quarters. The beginning of the year, everything was fine. This was pre-coronavirus in the United States. And it's for most of you at some point in the middle of March, roughly, you were forced to close your offices. So you see that blue shaded area, that's your basic office closure. And I'm hoping that we're going to be back, and again, in my examples I've been using, roughly around June 1st. So if that's the case, that blue area represents office closure. During that time, you are probably keeping your employees on unemployment because you didn't get any PPP loan money, and paying them only to the extent that they're probably coming in to help you with emergencies or do some administrative work. So we know that our wages will count during that time. But then we look at the decline in gross receipts definition. And basically, for most of you, that is going to apply in quarter 2. So if in the second quarter, your total collections, gross receipts, less refunds, if that number is at least 50% or lower of what it was in the second quarter last year. So you are basically down 50% as compared to the second quarter of 2019, then that second quarter is going to qualify. And because that second quarter qualifies, so does the third quarter. And that's because you're going to get that extra quarter before you're going to hit that limit. And that limit is, and what it turns off, is the quarter that begins following the quarter in which that revenue got as high as 80% of the same quarter in the prior year. So if you follow along in this, it basically says you had less than 50% revenue in the second quarter compared to last year. And then in the third quarter, we can assume that you got above 80% in the third quarter compared to the third quarter in 2019. So if that's the case, that third quarter is your last quarter. Now, if you did not get above that number, let's say you only did 75%, then honestly, the fourth quarter would be an option as well. I don't know that we'll necessarily need that to max out, but that's basically the way we look at it. So you're going to see that you've got only the wages during the closure, during the blue area, but all wages in the entire quarter if it's in that orange colored area as well. So you're basically looking at that sort of March 20th time frame of when you were forced to close, all the way to the end of the third quarter for most cases. But let's walk through a math example to try to work through that after we look at a couple of additional rules here. Now, it is important to note that this cannot include wages of any owner of greater than 50%. So for those of you that own your practice, you are not going to be included in this, nor any related individual. Okay, so client, spouse, kids, whatever, all of them are not going to be included toward this credit. So you can immediately exclude those. As we mentioned earlier, this does not apply to employers who received a PPP loan. It's an either or scenario. So if you got the PPP loan, this credit is not going to be for you. If you did not get it, then this credit is definitely going to be something that you want to consider. Okay. Now that credit is not just going to be a check that they write to you. It is a credit applied against your employment taxes, those same taxes that are filed on Form 941. So we're not sure yet exactly how that will play out as far as your ability to report that amount, get the credit, and avoid paying that in. To be honest, most of you would create more credit than you would have on that 941 anyway. And what we're learning is that the IRS is going to allow you to request in advance of that money. So basically a refund of any of those taxes you've paid in, or against future taxes you're going to pay to try to get that money faster. Because if not, a lot of you may be waiting several quarters before you're actually going to get use of this money. So it's something to consider when you're looking at it. But let's walk through a math example so you can see how it might actually impact you. Now, here's that same typical practice, GP practice, 1 doctor, 8 employees, reopening June 1st. And again, typical month has employee wages of a little less than 28, doctor wages of a little under 24. Now remember, doctor's not going to be eligible here. So the doctor's numbers really don't play into this. And we're going to assume that during maybe the end of the first quarter, but definitely in the second quarter while we were closed, we're going to pay something like $500 per pay period tops on average to our staff in wages to cover those emergencies and admin work. This is real data that I pulled from a client, $250 here, $48 there, a couple $100, another person. So call it $500 per pay period during that time. And then on June 1st, there towards the end of the second quarter and throughout the third quarter, we reopened at roughly 75%. Now, why did I choose 75%? Just to try to show you a little bit of how this might work if we weren't maxing everybody out. I've heard some people say they're concerned that the reopen is going to be slower than some think. They think that dentistry is going to take a little while to come back. People are going to have a lot of fear. You may be allowed to come back, but they're not going to be quite ready. Other clients are telling me that the patients are already lining up outside the door because they heard that it's going to open up in 2 weeks and they want to get in and they want to get seen. So we really have no idea what it's going to look like. I chose 75%, okay? So what does that mean? It means that technically we're under the number and we could work all the way into the fourth quarter if we needed to. But let's just assume we've got these numbers through the end of the third quarter or end of September. The wages you're seeing, of course, are less if you add them up per month compared to that 27.9 number, because I only assume 75% of revenue coming in. So in theory, we're going to have less staff hours and we're going to be efficient with our staffing. So we're potentially going to have less hours to provide during that time. So you're going to see something like in staff member 1, 2,800 and change in that quarter 2, and another almost 9,000 in quarter 3 that would be paid. And again, these were real numbers that were used. So you're going to max that person out at 10,000. So your available credit would be 5,000. Other employees like employee staff 3 didn't quite have enough to get to the 10. So their 8550 in this example would be used, and 50% of that is a lower number. So in this particular example, I'm showing you a typical office using real numbers from a client. You might be somewhere in the neighborhood of $32,000 in credit, to consider. Now that's free money because that's money right back, off of taxes you would otherwise owe. That's in contrast to the one I showed you before, where you're deferring $12,000 into the future that you'll eventually pay. So this is more like the forgiveness on the PPP loan. That's free money that you won't have to pay back. In this case, you're talking about $32,000 of credit that you would not have to pay back. Now, if you said, is it better that I just don't accept the PPP loan if it comes in to take this credit? I would likely tell you very, very unlikely. In most cases that we've reviewed, the PPP loan is far superior as an option compared to this as an option, even after accounting for unemployment benefits that might come in. But if you don't have another option, then this is definitely better than nothing. So we definitely think you should consider using this credit. Now, there's nothing you need to do to apply for the credit. It's just going to be available to you. Just a matter of properly handling those payroll documents, those 941s when they come through. And of course, to whatever extent you might need to document when the wages were paid, et cetera, using the payroll forms, using the revenue from your financial statements to show that you were within one of those particular quarters. That's all we potentially foresee as needed to be able to get this. So I don't know if the good news might be that there's additional funding that you might be able to take advantage of, or at least that if you can't take advantage of it, there is some silver lining to this cloud, which is there is some credit that you could utilize. So that basically kind of wraps up our thinking here on, if you didn't receive PPP funding, what you might be looking at or might be considering. Now, I know a lot of you are in a boat of, I anticipate getting that money, especially if there's a second round, or I already have it, and I'm not really sure how to best utilize this to make sure I don't make mistakes, and then I can optimize the amount of money I'm going to get. So we're going to kind of shift gears and start talking about that, and I'm going to send it over to Jason, who's going to walk you through that portion.
Hello, everybody. Hope you're doing well tonight. I know this is a lot of information to absorb, and hopefully there's a little silver linings in here, and there's some good news for people that got the loan, and there's some good news for people that don't get it. It's not the end of the world if you didn't get that loan. So good to present that tonight. And what I'm going to focus on in my portion of the presentation is, once we get the PPP loan, how do we maximize the utilization of those funds? If you think about it, there's really the problem with some of the stimulus, they kind of contradict each other. And so you have a situation where people are earning a lot of money on unemployment, but yet the PPP loan encourages you to bring them back at potentially lower rates. And so they kind of go against each other to an extent. And that's what's created the biggest sort of misconception about the viability of this loan as a stimulus option. So I kind of wanted to go through what are we looking at when we get the PPP loan. It's really important to understand there's three sort of limiting factors, or three ways that you'll be tested when you get this loan. The loan is intended for you to get people back on payroll, okay? And so when they start to judge your level of forgiveness, they're gonna look at equations that to determine whether you really did bring people back or not. Now, I've read this bill 100 times. Our whole senior planning team has. And I can tell you from the front lines, while the bill was written very, there's weird sections of it, and it appears to be sort of clumsy the way it was written. The further you dive into the bill, I've still yet to find a loophole where we can maximize unemployment while also getting forgiveness on the loan. So we've got to find a solution that sort of bridges those together. When you're being measured on this, one of the things they're going to use to determine whether you get forgiveness or not is full-time equivalent numbers. And what does that mean? Well, when you're fully staffed, if you're fully staffed, they'll compare previous periods when you were open and fully operational to your 8-week period of time. Okay, so your 8-week period starts on the date of loan origination. From that moment, they start to judge you based on your full-time equivalent numbers, because they want to know that you brought a similar size staff back after the loan and during that loan period. And so one of the things that we need to be cognizant of is this full-time equivalent number equation that they will test your loan on. The second is that any single employee cannot have a reduction in salary greater than 25%. The way the bill's written, it appears that it's on the employee level, okay? And so it looks like they compare your 8-week period of time to the first quarter of wages. So you take each employee, figure out what they made in the first quarter, scale that to an 8-week average, and then compare what you paid them in those 8 weeks to make sure you didn't cut their pay by greater than 25%. Now, it seems pretty confused. It seems these banks can barely figure out how to calculate the loan amount. They've had such a difficult time getting these applications out the door. It seems very counterintuitive to me that they would go to the microscopic level of looking at each individual employee to figure out if there was a greater than 25% reduction in compensation. But that's the way the bill, if you read the intent, that's what it looks like. Could they come with guidance out and says, hey, there's a more simple calculation. It doesn't have to be the employee level. It's very possible, but that's the way it reads. It talks very specifically about an individual employee in that language. And so, like I said, we've got to bring everybody back full-time. We've got to have same full-time equivalency numbers. In any employee that takes a reduction greater than 25%, that's going to dollar for dollar reduce our level of forgiveness. And so it's kind of a two-pronged forgiveness situation. And so they kind of really get you on both ends if you don't do this exactly right. The third thing that they've come out and stated in their guidance is that you can't use any more than 25% of your loan for non-payroll expenses. So that's the rent, the utilities, things like that. And so 75% of a loan needs to be used on payroll. So if you start thinking about this, I've got to have full-time equivalent numbers same to prior periods. Nobody can take a greater than 25% reduction in compensation. 75% of the loan needs to be used on payroll. It's very difficult to trick that system because when they start to look at full-time equivalency numbers, that's got to average throughout the 8-week period, just like it did in prior periods. And so it really does become difficult to find a loophole here to ethically beat this bill and maximize both unemployment and levels of forgiveness. Jason, if you can move it. There's a couple of strategies that we've heard floating around that I kind of wanted to talk about real quick. There's a strategy that was forwarded to me that said, hey, why don't I'll just leave my staff on unemployment and then rehire everyone on the last day of the 8-week period of time or the date of reopening. I'll pay them a big bonus, in other words, to get them up to the 75%, and then it'll be forgiven. Well, the problem with that strategy, and that's floating around on forums, I don't know if you've seen it, I've gotten it forwarded to me. The problem with that is you run afoul of the full-time equivalent calculation. And so if you had 0 full-time employees during that 8-week period of time and bonused everybody out on the last day, all you did was give a bunch of money to the staff, and that money's not going to be forgiven. And so that you've got to be cognizant of all these different equations they're going to test. Heard a strategy today where they said, hey, I'll just pay myself and my spouse to the max allowed for forgiveness, pay rent and utilities, leave the staff on unemployment, and then at least I'll get a proportional, share of forgiveness. Well, again, you would in that scenario, you would run afoul of not only the full-time equivalency numbers, but also the wage reduction. And so the likely result of that would be 0 forgiveness. Okay. I've heard of strategy where people are real interested in getting a little overzealous on, hey, I own my own building. I'll beef up rent. Can I pay extra utilities? Can I do this or that and the other? The reality of it is the drivers of this loan are payroll. That's what drives the forgiveness on rent and utilities. It's not overpaying rent. So if I own my building, I usually pay $5,000 a month. It doesn't do me any good to go then pay $20,000 a month because now I'm using my fund for more authorized uses. While rent is an authorized use, it doesn't drive forgiveness. The only thing that drives forgiveness is full-time equivalency. Nobody can take a cut and pay greater than 25%. You've got to use 75% of the loans for payroll costs. Now, when we talk about payroll costs, that's wages, retirement benefits, employer retirement benefits, and group health insurance. So we've got to meet all those thresholds when trying to get forgiven. The other hesitancy that I have heard, and I completely understand, is this idea that I got the PPP loan, and Jason, you're telling me I've got to bring everybody back on payroll, pretty soon. I'm concerned because my staff is going to get mad because they make more on unemployment than they do paying the getting paid through me. Again, that's a fair argument. The couple of, I haven't had a ton of people get approved for these loans yet, maybe 10 of 65, 15 maybe. So we've been working through strategies on how to get these going. And I haven't had a client so far yet tell me that this was going to be a big deal. Most of their staff, and I guess it depends on the state you're in, most of the staff, at least like Texas, for example, they're pretty tired of dealing with the Texas Workforce Commission. They've had a hard time getting benefits. They have a hard time getting on. They have a hard time if there's an issue. A lot of them haven't seen the $600 yet. And so for a lot of the people that I've talked to thus far, now that may be different once the 600's flowing. For most of the people I've talked to, there hasn't been a huge backlash of staff. A majority of them were just happy to be on a regular payroll where they didn't have to deal with the unemployment anymore. Now, just as an extreme example though, those people in Georgia, as just one of the states I looked at, there's such a high threshold of earnings in Georgia where you can work a lot and still get unemployment. For them, there are a lot of those employees that can still get a full paycheck or close to a full paycheck and still get state unemployment and still get fed. I'm still testing that out, but it looks like that's going to come to fruition. So in that case, there's absolutely no harm, no foul on bringing people back on payroll because their state minimum thresholds are so high on how much earnings they can have outside of unemployment. And so again, I could see this being a problem. At the end of the day, you went and worked hard to get a loan to pay these people. And one of the benefits of those loans is you'll get a forgiven salary for yourself. You'll get forgiven rent and utilities. And at the end of the day, these people are going to want a job when they get back. And, you're going to have to do your best to deal with those situations one-on-one. What we're doing here, what we've done is we spent the better part of the last 2 weeks developing an internal scenario analysis algorithm spreadsheet to help us maximize the utilizations of these funds. Because at the end of the day, like I said, we're trying to, if there's a way that we can maximize unemployment while also maximizing the forgiveness of this loan, we want to play with those strategies and scenarios with your exact situation and figure out what the best scenario is. So, and that could be, that's going to be dependent on each, particular client. Some of the scenarios that we may look at. So for example, that base case, that's just normal payroll. What is it? What are the benefits of this? What does the outflow look like if you just kept everything at normal payroll? Scenario one might be, hey, let's leave everybody on unemployment until reopen. What does that look like? We might look at a scenario where, for example, in the state of Texas, you can have earnings outside at your practice and still get unemployment. So if we're concerned about employees getting kicked off unemployment, what's the maximum amount we can pay each employee each pay period without them reducing their state unemployment? What's the max we can pay them where we leave a little bit of state and they still get the 600? These are the types of scenarios and strategies that we want to take and look at your particular situation and play that out over an 8-week period of time and figure out, what scenario does the doctor win the most? What scenario has the most total benefit? And then we kind of work from there to customize a strategy that works for you. In this particular case, we were able to graph all the scenarios, and you can see here the brownish color is the client benefit, the orange is the staff benefit. So for example, scenario one was leave everybody on unemployment. Leave them on unemployment until reopen, leave them on unemployment until you have to bring them back. You can see that pretty much makes this loan worthless if that's the strategy we're going to use in this particular scenario. You can see the benefit to the owner was negative. Now, by the time we got done playing with all the scenarios and customizing it for this client, we were able to increase the benefit to the owner by 70% while also increasing the benefit to the staff by 4% over the case scenario. And so by shifting around the funds, playing with each payroll, testing different things, adding the spouse at a higher rate, looking at pension funding strategies, what we essentially want to do is optimize those dollars, and keep in mind too that one of the things when we go back and think about the equations they're going to use to test us. Remember, full-time equivalent numbers, and nobody can have a cut and pay greater than 25%. One of the rules in the bill says that if you rehire everybody by 6/30 at full compensation, they give you a grace period through April 27th. So a lot of our scenarios up to this point have included minimizing compensation until after 4/28 so that we can preserve dollars when we're not being punished, and then starting after that. So those are the kind of things we have to play with. Do we start making payroll now? Do we wait until after 4/28? Do we pay everybody on 5/1? Can we afford to wait to 5/15? That's the kind of stuff we need to be looking at. And so when you get your loan, we'll run this specifically for each client and start playing with these scenarios and custom build that. As you can see in this particular example, there might be a situation where if we make one little tweak to the numbers, or we do one little thing to the numbers, it could have a $5,000 benefit to the staff where it only benefited the doctor $300 or $400. And so you're going to have to, as we work through that customization, you can play with those strategies and figure out what your threshold is and say, hey, if I'm only, if my economic, advantage is only $200, but the staff gets $5, what do we do? What do we do in that scenario? Are we really trying to maximize owner or staff? How do we build that? And so that's how we start to then, build the maximum scenario and start to make those little subtle decisions. There's not a single right answer for everybody. Every single one of these analysis that I've done has been different. What makes them different? Well, some staff have kept people on, And so I have some oral surgeons that have had to keep people, a couple of staff members on full time. Some people have kept their office managers on full time. Some people have, for whatever reason, they have an employee that they didn't feel comfortable taking off payroll because of a personal situation. And so through this, some of those people are already being paid, which is great because it does help. It's money you were already going to pay anyway and can go to some of those payroll thresholds. Sometimes if you look at the totality of your staff and look at every single employee, we literally get this down to the employee level, you might have an employee where their earnings are so low that by paying them through the payroll, it kicks them off unemployment in the 600, and the delta or the difference between what they would make on unemployment versus what you would pay is so dramatically big. It's so big, like they might lose out on, $600-700 a week. In that case, we might customize that to keep their compensation a little bit low to keep them on unemployment. Again, that's a decision based on the doctor. Some clients have spouses that we can beef up on payroll, some don't. So that would be a scenario where it's different. Some clients have associate with commission-based structures that might affect the FTE calculation a little differently. Not all clients have pension plans. So if retirement is a component of payroll costs and we're trying to get up to 75% because for some reason we're not able to get up to 75%, can we pre-fund or preload some of that profit sharing or employer or cash balance plan to help chew up some of that 75% difference? Now, in the scenarios I've done so far, I'm assuming that you can beef up some of those pension numbers. I'm not sure once guidance comes out how they will view that. I'm hoping they give us better clarification on that. For the clients that I have in that situation, I've basically to this point recommended minimum funding on the pension plan with the idea that if we get 6 weeks in and we have guidance on this and they're not spending their full 75% on payroll, we could dump a bunch of money into the pension, then that might be a reasonable opportunity. Again, some people have their staff costs relative to rent and utilities is at a different mix. Everybody's going to fund at a different date. And so you're going to have a different strategy for someone that funded on 4/15 than someone that funded on 4/28. And like I said earlier, some states have richer unemployment benefits than others. And that certainly comes into play, because if you can get away with paying them full pay and it doesn't affect their unemployment, then everybody wins. And it essentially it's a slam dunk, no brainer deal, because they're getting the best of both worlds. That seems odd in the world, in a capitalistic economy that we live in, but it's just the reality of some of the stimulus kind of creates these weird double dipping effects that, we didn't write the law. We're just reporting it and doing it exactly like they've asked. Now, what could happen from here going forward? Like I said, the SBA and the Treasury has given guidance on the loan amount and what we can use it for. They have not issued guidance yet on the forgiveness. I believe from a legislative perspective, they have 30 days to do that. And so I hope that by the time most of my clients get into their second week of the 8 weeks, we get a lot better information on the guidance of forgiveness, and we can tweak those plans if we need to. The other issue is that just like every bank was a little different on the front end, every bank could be different on the forgiveness calculations and how they'll treat that on the back end. And so, again, we're going to have to be a little bit fluid and deal with that as we go. In the act itself, there's a couple of areas that it's very hard to make an interpretation that could lend itself to some, like I said, tweaking once we get some guidance on this. There's an issue in there. One of the kind of controversies is costs incurred or paid during that 8 week period of time. You understand that that's a different thing, right? Like I could incur utility bill during my 8 week period of time, but I don't pay it until 2 weeks after. I could incur payroll. I'll give you an example. If you closed and your loan origination was on 4/16 and you had a payroll that ran and came out of your account on 4/17, but it was really for hours earned prior to your 8 weeks, do they get that nitpicky between when the cost was incurred versus cash, when the cash went out? I tend to believe just making a bet that it's a cash basis deal where they look at the cash that flows out during that period of time. But again, we need more guidance. Is the forgiven expenses, if we are forgiven, are those expenses that we paid, that payroll, all that, is that going to be tax deductible? They haven't addressed that in the bill, because that would kind of be a double whammy or a double dip there. If I got forgiven and theoretically the feds paid for my payroll, but do I also get a deduction for that money out? There's some precedents historically that when you get a credit like that or free money like that, you can't write it off or take a deduction for it. They haven't issued guidance on that. Is there going to be an exclusion for self-rental? So if I own my own building and I can sort of manipulate rent to an extent, is there going to be some sort of carve back there? We don't know. Right now we're in what we would say is a grace period. And so as long as you hire all your employees back by 6/30, they're not going to count against you a reduction in full-time employees or wages through 30 days after enactment, which is 4/27. So right now we sit in that grace period today. If you've already started your 8 week period of time, what we don't have clarity on, while they say they're not going to count it, they're going to disregard it for purposes of the FTE test and the salary reduction test. We just don't know how that plays into the calculation. It kind of makes the calculations a little wonky when we're trying to run our internal algorithm. One of the biggest questions I talked about earlier is, will that salary reduction, you can't reduce anybody's salary by more than 25%. Will that be determined on the employee by employee basis, or will it be determined in some sort of aggregate calculation of total payroll? I'll give an example where this would come into play. Let's say you had a hygienist that worked for you from 1/1 to 3/31, and they're no longer coming back. So let's say that person made $10,000 in the first quarter. Well, it's impossible to pay that person now because they no longer work for the practice. So what do? Well, I think if you rehired someone, you would replace those hours as far as full-time equivalent hours. But the way the bill reads, that person theoretically took a more than 25% cut in pay. So when we say we don't know if it's going to be determined on the employee level or an aggregate level, that makes a huge difference in the calculations, because when you replace somebody, you can't fix that salary reduction issue. And so those are a couple of things in the bill that are still being debated, that are clearly confusing. And so we have to make our best assumptions when we do calculations, when we give recommendations. We look at the bill. We go back to the bill. We don't read articles by Forbes. We don't read articles by the Wall Street Journal. We go back to the bill and try and understand their intent there. And so that's kind of where we're at on some of those issues that haven't been answered yet. So what do you do now? I'm getting emails all day long. I'm not trying to make anybody jealous, but there's some clients emailing me today going, hey, I got approved for the loan. Okay, what do I do now? This is important. So we got an origination date of 4/16. What do I do, Jason? Well, at this time, the first thing we got to do is make sure we understand the origination date, because that's when the eight weeks starts. So our 8 weeks is now ticking, okay? At that point, we need to get in and run an analysis and do a simulation through this algorithm program to run different scenarios to figure out what the best strategy is to maximize your dollars, okay? What information do we have to use to include that? Well, there's 3 or 4 different time frames back in 19 and 20 where they want to look at hours. And again, they're going to compare that for the full-time equivalent hours test. And then there's wage ranges where we've got to figure out, you know, did anybody take a salary reduction? So there's a lot of payroll reports that have to be pulled and data that has to be inputted. So if we're going to get the analysis done, if you're going to your advisor, you've got to provide all that data to be able to get that analysis run. Okay. If you're an MLW client, obviously we have access to that data. And so we'll pull that for you. We pull it directly into the, we actually built it so we could export directly from the payroll company. And so, yeah, so if you want to know what we've been so busy with and why we're so behind on emails, texts, and whatnot, and calls, is because we have been buried in this calculator trying to get it to automate to where we can serve everybody to get this done. Because without some sort of automation or exporting or interaction between the data and the calculator, you know, it'd be 6-7 hours per client to look at this. So we've been working hard trying to automate that. So as you get your payroll, your PPP loan money in, we can quickly analyze that and come up with a strategy. The other big issue is, and I've seen a lot of this, is once I get the loan, how do I track to make sure that I'm tracking everything appropriately? So when I go to the bank, I can ask for forgiveness. What information am I going to have? I've seen a lot of recommendation out there to say you need to open a separate bank account. I'm going to open a separate bank account. I'm going to run my payroll through there. I'm going to run my rent through there. I'm going to run my telephone, utilities, all that stuff through there. That way I have one singular account. I can easily pull that data. I can easily give it to the banker at the end of the day. I think that's a very, very valid strategy for people that don't have good accounting in place. And so a lot of clients have asked me, do I need to set up a separate bank account? My answer is no, you do not. Why? Why would the banks be recommending that? Every forum is recommending that. Everybody else is recommending that. Why would you not need to? Well, because in our system, our accounting is caught up. Most accounting firms are 4 or 5 months behind, all right? They don't integrate with payroll. They don't have that level of integration. We're going to be able to run a P&L that is real-time caught up from 4/16 of your origination date to June 16 of when that 8-week period of time. We will have everything perfectly clean and reconciled so that when you go to the bank, you can take that data, give it to your bank, and try and apply for forgiveness. Not everybody has accounting. Not everybody that listens to this or gets passed around to colleagues, do they have that level of accounting? And I'm going to take just a little minute to brag, but this is the reason why we're so relentless on clean accounting, because you will get caught in situations where you need that data quick and clean, and it takes forever to go back and catch up 4 months of accounting. And so for our clients, obviously we'll have that. That's why we say you don't need to set up a separate account, because we'll track all that for you. Whether it's in account 1675 or 1182, it doesn't matter to us. It doesn't help us in tracking that. We'll be able to track it either way. If you're in a situation where your accounting's behind, you don't have you use a bookkeeper that's not a real accountant, and they're behind and it's sloppy and it's messy. Payroll is one of the hardest things to track. Then probably makes sense to go ahead and set up a separate bank account and track that. That's why our recommendations might differ from what you would see to the masses. So let's kind of look at this on a timeline. This helps us understand it here a little bit. So we've got our loan origination date here. Let's just call that 4/17. At that moment in time, we're going to do our initial MLW analysis to strategize what we need to do to maximize these dollars. That 8-week period of time is starting. Now we know that for those that have started before April 27th, we've got that grace period. We're going to get into this. We're going to start paying payroll. We're going to come up with a strategy. We're going to get it done. Okay. We'll get the initial strategy implemented. One thing we're going to do here internally is after you're done with your 6 weeks. So we've got a database in our software. We're tracking every single client and their loan origination date. So we know when every single person's 6 weeks is up. After the end of 6 weeks, we're going to go in and do an analysis, because we need to start testing your payroll numbers to make sure you're on pace to get full forgiveness. So we'll start testing that data, and then we can reach out to the client. Again, we're gonna have another call and say, hey, looks like you need to do this. I recommend doing this. Now we know on the pension you can fund that. Hey, it might help a little bit if you gave everybody a little bump pre-bonus, whatever the case is, to shore up some of these differences to max forgiveness. So once the 8-week period ends, hopefully we've done a good job managing those funds and trying to max forgiveness. At that point, you would go to the bank and apply for forgiveness. So we sort of envision, I don't know if this is going to work out, it may not, but we sort of envision creating a report for each client with all the supporting data. So literally all you have to do is email it to the bank and say, hey, here's all the calculations, here's all the data, let me get this forgiveness and let's move on. Now, one thing that's important, when that 8-week period ends, you start a 6-month deferment on the loan payment. So if you were in a situation where not all of it was forgiven, let's say you got a $100,000 loan, $20,000 wasn't forgiven for whatever reason, we weren't able to bring people back as quick as possible, we didn't really, our goal wasn't maximization, whatever the case is, whatever the situation is, you got a $20,000 loan there at the end of 8 weeks. Okay, you have a 6-month deferment on payment. You don't have to make payments. So we don't have to make any decisions at that point. Now, once the 6-week comes up, now we have a decision to make. There's a couple options we have. One, we could start making payments on that loan. I've heard a lot of people say, oh, you don't want to be stuck with this loan because it's an 18-month loan and the payments are going to be pretty high relative to the amount of number. Hopefully the total dollar amount of loan isn't that big to begin with. It is a 1% loan. If you can afford it from a cash flow perspective, maybe we just make the payments. Maybe we're in a situation where things have rebounded. We've got a little extra cash. We just pay the loan off, not a big deal. The other option is if the loan is big enough, we don't have the cash to pay it off, we don't want to make those monthly payments because we're kind of high, then we would start to look at our regular bank to refinance that out and drag that out over a longer maturity. And so we have some option at that time. But for those of you that have this loan or going to get this loan, you can kind of envision this whole 8-week, 6-month thing as, hey, we're going to have to track this down to the penny during that time. And from our perspective, and this is why we've been so busy, is trying to figure out how we can do this en masse to make sure all of our clients have the data they need, they maximize the loan, it's easy for forgiveness, so you're not out there drowning trying to figure all this stuff out.
All right. So Jason, we've got some questions that are coming in. I figure we can just kind of work on these together a little bit. I did want to remind everybody, I think you just mentioned it actually again, but that, for our clients, what you were trying to show in that scenario wasn't designed to be the answer for everybody that's listening, and that each of our clients will have an individualized scenario or answer that we're trying to get them to give us that information so we can run that analysis for them. So it's important to kind of remember that. All right, Jason, so we've got questions kind of covering all of the areas that we covered this evening. I'll let you take this first one. Would it still be okay to apply through PayPal or other small banks in the event that Bank of America hasn't even made contact since April 8th when those documents are uploaded? So in other words, if you can't necessarily communicate with them to get an assurance that that's not going to get sent through the SBA, what do you think we should do?
Here's the situation. I think you need to take a step back real quick and say, what is the risk in doing that? Okay. The feds and the banks are concerned. Is it illegal to apply for a loan at two different places? Absolutely not. That's not a problem at all. But you could run into a problem. Okay. And the problem is that, the feds and the banks are very concerned that there's going to be fraudulent loan claims within this program. And so what happened after Hurricane Harvey is there were fraudulent loan applications that went in and people were getting multiple loans. So while it's not illegal to apply multiple times at multiple banks, it is illegal to take two different loans. So what could potentially happen is if Bank of America and PayPal just happen to submit your loan to the SBA around the same time, or whatever that case is, if there's not a good situation there, our concern and the risk is that somehow that flags you as a potential fraudulent multi-loan person. And so we're not, and when we talk about this, we're not saying you shouldn't do it because it's illegal. We're saying we don't know if the SBA will set up a system and they flag it. And I'm telling you right now, a 10-minute flag could be the difference in you getting the money and not getting the money. I mean, like, I literally think, I think one of my clients literally got declined because they filled out the wrong application, and that was it. The SBA already had everything in their hand. They just filled out the wrong version of the application. And that probably was the difference. No difference in information, but it was just long enough a delay to not get the money. So our biggest concern is that if BOA has already sent that, and you haven't heard, but you don't know, because you don't know, they haven't sent it, and they send it, and then PayPal sends it, and then somehow that overlaps, and you're stuck, and you get flagged because they think you're trying to get two loans. That's what our concern is. It's not whether you can apply at multiple places. So if I'm in that situation, I have to look at that myself and go, you know what? What is the bigger risk? I haven't heard a word from Bank of America. That's scary. So is it more risky that Bank of America, you are stuck in some Bank of America black hole vortex that nobody knows your loan exists and you can't get it? Is that a bigger risk that it's not ever going to make it to the SBA, or that two banks are going to send it at the same time and it's going to get flagged? I don't know. I mean, if I'm in that situation, honestly, and I haven't heard from my bank and I don't know, I'm sending another application in. I can't roll the dice on that. But from a criminal perspective, there's nothing illegal about it unless they were able to prove that you were intentionally trying to get multiple loans, which hopefully nobody on this would do it. But it just may appear that way and slow it down a little bit. That's our concern.
So we got a question that's specific to one of the comments that I made, which was, if you chose to wait, then you probably bet wrong. And the thinking here was, how did I bet wrong if we're about to have more money in the PPP money pool? Then when I get it, I'm going to have full forgiveness. So let's assume for the moment that you are actually going to be able to get to full forgiveness based on the stipulations, Jason, that you walked through. My answer to that would be, number one, the money's not in there yet. I do still think that Congress is going to find that second pool of money. We don't know exactly how much yet and when that's going to happen. But in theory, if that does, then you would be eligible for that. But our takeaway from this tonight isn't that it's impossible that you could still get money. I think that it's potentially a more risky bet that you took that could still play out. But keep in mind that the time frame is likely going to be even tighter than it was with the first round. All of the applications already in, they're going to be in line first. And so we've got less money to play with, and potentially more people now desperate because they realize they missed out the first go round. So I think there's still the potential that money may not get funded. Really, all we're trying to get across is the point that if you want to get PPP money, basically, I would advise trying to get on that application as quickly as possible, just to make sure that you don't get left out on any secondary funding. Okay, Jason, I'm going to send you another one. If I received an amount through the EIDL loan through the SBA, will it affect my chance of the PPP coming through?
I don't believe so. I think those systems are completely different. So with the EIDL loan, or the EIDL loan, as I learned today, I didn't know what that meant, but I learned today that we're calling it the EIDL loan now. But it's really the Economic Injury Disaster Loan. That loan's directly to the SBA program. My guess is that's on if I want to vision, I guess it's probably all on the same computer server network system. But my guess is those are two different, totally different things, where they're completely separate decision. They're completely separate divisions. One is going through a bank like the PPP loan. One is directly through the SBA. One you just apply online with the SBA. One you have to go through this bank. I think they're completely separate. I can't imagine that would hurt your chances at all.
Yeah. Someone brought up an interesting point about overtime. And they said, what about overtime? Would that count for payroll expenses and, potentially maximizing forgiveness, assuming that, we are going to have a lot of patients to catch up on and that sort of thing. And, my take on this, and Jason, I'll let you talk as well. There's nothing wrong with overtime, and there's nothing that says it would exclude overtime from any of the calculations. So again, what does that help? Okay. So obviously more of that money just means it's going to be going to your staff. But in this particular case, you're actually back to work. So I assume that's why you'd be running overtime. So you absolutely should do it if it means you're going to be back to work, seeing patients, but it would be eligible for forgiveness. In fact, if you wound up short on numbers earlier on, then that potentially gives you, the reason to improve your FTE numbers for that calculation, the amount that goes into any wage reduction part of the calculation. So if you do wind up in overtime, I think you'll be just fine. In fact, you may be in a better position if it does wind up working out that way. Now, we don't recommend forcing a lot of overtime money through per se, just for the sake of doing it if they're not working, because you are still paying 150% of normal rate. And you got to be careful with that. But I think if you're back to work and you've got patients to see and you've got staff that are willing to do overtime, then as long as there's PPP money available, then absolutely that's a good use of it. And even if not, if it means you've got revenue coming in the door, I'd probably recommend it still. I think more than anything, we've got to figure out how to execute these strategies, but keep in mind the top priority, which is getting your business back up and running and making revenue again and moving this past this crisis that we're in. And I wouldn't do anything that potentially slows that down in order just to try to get some small tax advantage out of it. I would put the priority first to getting your business back up and running the way it needs to be. Jason, if your spouse was not on payroll before February 15th, can we add a spouse in payroll now to beef up that 75% wage threshold?
Oh, I think you're asking the wrong person on that. I'd probably be tempted to roll the dice on that, but I'm not sure all my colleagues here would. I mean, I don't know. I think that there is the potential optic that you're trying to artificially prop up your numbers or boost your numbers. Is that an ethical dilemma? A moral dilemma? That's where you just kind of, is there anything wrong in doing it? No, but I think it could optically look from the bank's perspective that you were trying to boost up your numbers. And so you just have to be cognizant and just like anything else in life, I think you've got to run that through your scope of, to me, it's a moral issue, I can't answer that question for you.
Well,
I don't know.
And I guess it's specifically.
Do you have thoughts on that? I mean, I think me and you could argue about this, and we've argued with other planners on that. And for sure, it would help your numbers. For sure, it really helps get that 75% up. It's not going to help you on full-time equivalency, because you're not allowed to use people that made over $100,000. So if you boosted it up to 100, I don't think it would help your full-time equivalency. It definitely wouldn't help salary reduction because you didn't pay them in the first quarter. And here's another important point. Increasing other people doesn't make up for your decrease on other. So you can't overpay certain people. If it is, okay, if it's an aggregate, if they look at it on an aggregate level, maybe that works. If they look at it on an individual level, you can't use your spouse to overcome the fact that you didn't pay Jenny or Tom because they weren't on payroll anymore. And so it does help with the 75% threshold. Would you add them now? I'm not going to stop my client from doing it, but I'd prefer not to answer that to the masses, honestly.
No, well, and just to be, clear to everyone, when we're talking, we can get a little confused when we talk about that 75% threshold. So, Jason mentioned it would definitely help with the 75% threshold, and then said it definitely doesn't help with the wage reduction piece, which has a 75% threshold. So he's talking about two different things there. 75% threshold, meaning the amount of the loan that you can use toward payroll versus non-payroll expenses. The reduction in wages below 75% of what they used to be, that's where he's saying that does not help you there, because as he mentioned, it's an individual basis. So
and just to expand on that, where you could get yourself, because theoretically, if you brought everybody back on payroll, you wouldn't have a problem meeting these thresholds, but you could. I'll give you an example when you can run into that problem. If we're in a grace period right now until 4/27 and you closed on 4/15, well, I'm going to tell you to the extent we can, skip that first payroll. So you're skipping an entire payroll of the 8-week period of time because it didn't help or hurt you anyway. So you skipped it. And that's why you could start to run into problems on salaries, or not really salaries, because I think they'll scale that time after that, but you could run into that 70 where you didn't use 75% of your money towards payroll because you skipped an entire pay period. While it didn't hurt you on full-time equivalents or the reduction of salary per individual, it did hurt you on the totality of meeting 75% payroll costs. And so that's the issue.
And I mentioned I was going to ask you about the overtime. Did you have anything to add differently on the overtime question?
No, but I had an interesting discussion with a client yesterday that I was helping do this, and she was an orthodontist, and she had an interesting point. She said, Jason, listen, as soon as I open, and based on where they're at, I think they're going to open a little bit earlier than maybe some of the other parts of the country, but we're going to open up here. Let's call it May 1st. I don't know. I'm just using an example. Or maybe it was later than that. I'm going to open up May 10th. I've run the math, and I really think I'm going to have to go from 32 hours a week full time to I'm going to have to open up 40 hours a week. I'm going to have to add an extra day to account for this backlog of patients that needs to get in. Can I afford to skip a payroll that is outside the grace period? I'm going to skip that 5/1 payroll, and I'm going to wait until 5/15. I'm going to let everybody get their unemployment for one more time, and then I'll start on 5/15. Can I afford to skip the payroll when it matters, when they do count it, and still meet these goals? Because theoretically, each employee is going to jump from 32 hours a week to 40 hours a week. So I'm going to get an extra 8 hours per week for the last 6 weeks of the 8 weeks. And theoretically, my wages are going to go up too because of the additional hours. So is it possible? And that's kind of the scenarios that I'm talking about that we need to look at. Is there a way to skip another payroll and let them get unemployment or paid minimal, let's say, get a little bit of hours in, get a little bit of compensation in, and still meet those goals? That's an interesting idea. I haven't been able to fully vet it out, but it was an interesting thought that, hey, I'm going to be so busy when I actually do open, I might make up for some of these things. I don't know. I haven't had a chance to vet that out yet.
One of the questions that we got was referencing an optimal scenario. So if I talk with you and you come up with my perfect answer, and then it turns out I was supposed to put employees on unemployment or pay them up to the minimum on the 4/17 payroll as an example, or the first payroll that once you get your loan money, what if I've already run that payroll? What happens then? Because now I'm off that optimal scenario. And the only thing I would add to that is when we run those, we go ahead and put through real life what happens. So for example, any of my clients where I've looked at their optimal scenario or optimizing the PPP loan money that we've, that they've already received that money, We looked at what the payroll was run on 417 for anybody being paid for emergency cases or anything along those lines, and whether or not the doctor paid him or herself. And we already worked that in as real data into that optimization going forward. So there should not be a scenario where you're working through an optimization strategy, whether it's with us or if you have an advisor somewhere else that you're asking to help optimize this, where they, we wouldn't be able to look at real data as a starting point and build from there. The more knowns you have, the better the projection will be, just like with anything. So I don't know that that's necessarily going to be a big issue going forward. So next question, Jason, kind of a two-part piece here. What's the, and it kind of goes together. What's the best way to communicate to employees if I'm going to be putting them back on payroll before we open the office? And what they mean by that is, if I'm going to be paying them through payroll, what do I need to do with the employees regarding how they're going to report that to their, particular unemployment office? And then the second part of that question is, I know you mentioned that you're not seeing a lot of issues with people wanting to come back because of the nightmare that unemployment's been in some of those cases. But if you have an employee that's not really wanting to, can you force them to come back, or what other issues do you have? So kind of two-parter there.
I haven't had to cross that bridge yet, but I can tell you that for the clients that I've had to develop this for, in some scenarios, depending on the state and when they have to report their earnings, I literally had to go by employee and predict what the hours and the earnings were going to be for the 8 weeks. And so they would know how to, because the challenge becomes is you're going to have to report those earnings. Well, if they're coming back on May 1st and you haven't started reporting to the state, it may overlap to where you have to report to the state before they're actually paid. So they definitely need to be communicated that they're coming back. So that they know to report those earnings as they go. And they need to be informed on what those earnings are going to be, which is probably similar to prior history. What are the legalities of if someone says, you know what, I'm not coming back? I don't know. Can you just tell them that, okay, then I'll accept this as your resignation, you quit, you don't have a job now, and you're not going to get unemployment? Can you do that? I don't know. I don't know the legalities of that. At the end of the day, you're paying them to do nothing. And only in this weird world that we live in would people be mad to get a consistent paycheck during an economic crisis. But it is the situation we're in. And I'm dancing around your question because I don't know what to say at this point. I don't know. I haven't had that yet. But I think it's the way you frame it. And, some of my clients, they paid for people to get paid before they got unemployment. They gave them a little extra on the back end. And if it's me and my employees, I'm going to have an honest discussion with them and say, hey, this is a business that we all work for and we need it to survive. And I went out and got this loan that I need to help me pay my rent, to help me pay my bills while we're trying to get back open. And I need you to be a team player and take this for me. And that's why I said earlier, when you're running these scenario analysis, sometimes you're going to have a person that the delta on unemployment versus earnings is so great that you just take it a little, you let them stay on there and you don't worry about it, and you minimize their pain, you just let them have it. But most of them, and anybody that's making better money is not going to have a problem with it. Again, you're talking isolated employees, probably $15 to $16 an hour employees that might have a problem with it. And I think you got to have as a leader of a business, you've got to get on the phone with them and tell them like it's going to be. And if they're not going to deal with it, then you need to make a decision on how you're going to proceed. But I don't know if you can force them. I mean, you could say, hey, you're going to get a paycheck on 5/1 for this and this. I mean, what are they going to do about it?
Yeah.
Decline it, not take it. It's going to get wired into their account. So at some point they're going to have to come clean with the state, but I don't know. I'm dancing around that question. I don't have a great answer for that yet.
I think
it hasn't been a big problem.
Yeah, and I think that in discussion with the Texas Workforce Commission here in Texas, that they basically reference what you said, Jason, which is if you've returned or made an offer of employment to somebody and they decline it, that's effectively a resignation. Now, whether or not that works itself through the system or that the system ever finds out about it is another question. And as backlogged as they are with just unemployment claims, there is no guarantee that they will get through to that. But if you think about it, if you take the steps of reporting that to the Texas Workforce Commission or your state unemployment, you've documented some way that you've done those things from an HR perspective, and you can provide that evidence if requested, then I think you, in theory, could basically kick them off unemployment. That doesn't necessarily mean they're going to come work for you. Now, I have had a few clients, in just wondering how they would handle this, that basically said, look, if I offer you a job back and you say, I don't want to come back, and there's not like a valid reason for it other than you like being at home and earning money for not doing anything, they basically alluded to the fact that that's not somebody they want on their team, and then they'll just find somebody else. Now, I don't know how easy it is to find somebody else, but I guess to some extent, you still have employees that are going to need jobs once this unemployment runs out, especially that federal $600 piece at the toward the end of summer. So, you know, when that happens, what's the job market going to look like? It's a gamble that if they're willing to play, maybe then it's something that they could take on. A question that we're getting is, can you prepay rent, utilities, or even doctor wages to get it paid during the 8-week period to count for forgiveness? So let's talk about the wage piece first. You got to remember that if you are paid more than $100,000 equivalent per year, then you are going to be limited to the amount that you can count toward forgiveness. So, you know, if you run that math out, it's going to roughly be somewhere in the ballpark of about $15,300 over 4 pay periods, which is what most people have in that 8-week time frame. That's assuming, you know, biweekly payroll. So there's only so much you can pay before it stops counting, at least on the doctor side of things, which is mostly what you care about if it's about benefiting the doctor. As far as the other pieces go, you know, Jason alluded to the fact that there's some language in the guidance that is, and for that matter, in the bill with really without that much guidance, that suggests that it may be incurred and paid. So the question, of course, is it both, or are you saying it can kind of be that and that, as opposed to it has to be both? And there's no clarification on that yet. But if it turns out that it does in fact have to be both incurred in the time frame and actually paid in the time frame, then you can't really prepay any expenses, nor can you delay paying them that you were incurred prior and then pay them in that period. Is it hurt to try that and it just doesn't get forgiven? No, but it's not a guarantee that it will actually help. So I think you have to just kind of look at that as it might help if you've got money that you need to work through. Keep in mind, though, that non-payroll related expenses can only make up 25%, and that's not 25% of the total loan. It's 25% of total forgiveness. So think about it from a perspective of, hey, if I get $100,000 and I can meet the thresholds for everything somehow, that means I'm going to have $25,000 of available loan to use towards these other costs because I was allowed a $100,000 loan. But if in fact you wind up, because of reductions or because of low payroll, that number winds up much less, then it's only going to be 25% of that number. So it's
all right, everybody. I think we lost Jeff there for a minute. That's what he gets for being cheap and buying bad technology. And so I think we're probably nearing the end of this. I know there's still a lot of questions out there. We got a question about, and I think one of the biggest issues that we're going to face is what happens when we bring these staff members back and they are having to take care of their kids because the schools are closed. I don't have an answer for that off the top of my head. It is a question that we're trying to get answered because you do have some interplay with the sick pay that was eligible under the section 2 of the bill, and would they be allowed to use that during a PPP loan period, and would that affect you? Well, the issue with that sick pay is you do get a full credit for any of that's paid. So while it would theoretically reduce your PPP forgiveness, you would get credit for that from the feds to pay during that time. I just don't know enough yet on the interplay of those. Some of these things, we've had to learn these bills in isolation, and now we're getting to a point where the interplay is causing some problems and some bringing some new issues to light. And I know that that's one of those questions that we are vetting out and trying to figure out how we build that into our solution if that were the case. Because theoretically, I mean, from my perspective, the biggest issue on that is you could run into workflow issues and not having people back if everybody's got to be home taking care of their kids that aren't in school. So that's a question that we are going to get addressed and figure out what the best solution for that is. Other than that, I think we are all done here. Jeff has gone completely silent over there. And like I said, he's known for being a cheap guy. So my guess is he's having technology issues over there because he saved a couple $100. So I'm just taking a guess that that's the issue. But I'm going to let you guys go. And I just want to say from everybody at MLW that this has been a really trying time. And I know we've all sort of been forced on this sabbatical that we're having to take. And gosh, it would be great if we didn't have to stress during this time. But unfortunately, the sabbatical that's hit us, we've been stressed the entire time, worrying about money, worrying about research, worrying about understanding these things. And so just know that we're in it with you. We're in a little different situation because we've actually been super busy and swamped. And you've been totally stressed, worried about money. I'd rather be busy and swamped than worried about money. So we certainly are empathetic with you guys. And we know that the end is hopefully coming soon, and we can all get to work and get back to doing tax returns and complaining about helicopter parents and bad patients giving you a hard time over this, that, and the other. So y'all have a good evening, and we may be back with another webinar at some point. Hopefully at some point it's good news. So y'all have a good evening.